This conference will now be recorded.
Good evening, ladies and gentlemen. This is USA Trading Frank. It's approximately 9:08 p.m. on September 8, 2019, Sunday evening. This is a live strategic weekly update webinar like we always do. Very, very useful, very resourceful, and details out the technical forecasts on what the market might be doing over the next couple of days, over the next week or two, and some extremely important economic catalysts that we point out so people are prepared for all the volatility intraday and intra-week that we can expect. Full disclosure, this is purely for financial education, not for any solicitation or advice. The session will be recorded, uploaded to the Google YouTube channel for further viewing by members and free trial subscribers, and anyone out there with the internet connection who is involved in the US stock markets or interested in the US stock markets. Very valuable resource, as you know, and please listen, review it, hopefully prior to trading on Monday. Session will be uploaded within the next hour, well, after it finishes, probably within the next 2 hours or so. Depending on the time zone you're in, you should be able to review that prior to market starting tomorrow morning, Monday. So, welcome and good evening. We have our loyal and very focused member, Jody, here in attendance, and I'm sure some other people will be filtering in. After all, it is a beautiful summer evening, so I don't expect people to basically sit around and listen to technical forecasts and stuff like that, but I think it's very important because this makes us money. It's really as simple as that. So first of all, like we always do, we're going to go ahead and give you the broader picture, then we can zoom into a couple of charts, talk about a couple of stocks, and have you guys all prepared to do what you need to do. Always remember, the ultimate decision lies with you. All trade alerts, tactical charts, precision alerts, and precision charts, market analysis, quick breakdown on market volatility, everything is our very accurate suggestions. I repeat, the final decision always lies with you, whether you want to pull the trigger on the buy or sell button. That's it. That's it. Always remember that. The responsibility is yours. Hi, Jody. Are you fully connected? Screens and audio?
Yes, I am, Frank.
Okay, very good, sir. Try to make this brief and to the point. So on a broader level, everything that we talked about, and I repeat, everything that we talked about from last Sunday came true. And last Sunday's strategic webinar should be in the Hall of Fame. Now, I don't need to tell you that because it's right there. You can go check it out. Many of you acted on it, and many of you profited from it in a big way or in a small way. So tonight, hopefully, will be the same. We talked about, we opened up on Tuesday because Monday was Labor Day, on September 3rd with a big thump down. If you review the charts and you not just review, reviewing is just like, okay, looking at a beautiful piece of art, but not really understanding it and not acting on it, right? What's the use of a roadmap? What's the use of a GPS navigation system if you're not driving the car or whatever vehicle that you're using and trying to get to that destination? That's the emotional, mental part, which in most cases is the majority of what trading and investing is all about. Trading, like the old cliche says, is not a spectator sport. You have to be in it to win it. It is a risk game. It's a quantifiable risk game. Where the house, in this particular case, the hedge funds, the mutual funds, the Wall Street, the big financial houses, they, in a lot of cases, are on your side. In the case of pure gambling, it's an 80-20 split. The house will give you 20%. The house wants to make 80% profit margin. So regardless of how good you're in poker and what other games you play, and I don't gamble, so I don't know. The thing is that they're going to take 80% of the winnings. But in the case of trading and Wall Street and investments, in a lot of cases, yes, they are fighting you in the sense that they want to make sure you're out of a position before they take the market higher, or you get too greedy and get into a position before they take the market lower. But in most cases, I would say, and this is a guesstimate, that it's a 60-40 split. Like 60% of the time, the house is going to be on your side. So you got to keep these things in mind when you want to become a more consistent trader and a more consistent investor. This is quantifiable gambling. And when you talk about options, which are high risk vehicles with smaller amounts of money, the risk reward ratio is skewed very to a large degree to high numbers: 100, 200, 300%, 40%, 60% on an intraday basis, sometimes 1000%. And we show that repeatedly. So the point is that these are outsized numbers, but in order to win or grab the meat in the middle or a large percentage of those type of moves, you need to be in it to win it. Now, one of the things I talked about this morning on a fantastic, and I loved it, on the free ACS or advanced coaching session, where we had one of our newer members who's been with us for a couple of months joining us from Switzerland. From what I could tell, that great member Patrick, I think he's probably on the German border side, because Switzerland borders both France, Italy, and Germany. Asked some terrific questions, some basic questions, which every trader should have, and I answered them to the best of my knowledge. And he seemed to be satisfied with the answers, and he's going to try to apply those principles and move along. So please review that. Doesn't matter whether you're an advanced trader or an amateur or just starting out. It is a great ACS webinar I put out there this afternoon. So please review that. It'll help you a lot. So saying all that, we are on the fifth inning of this move here. Doesn't mean we're going to go into a complete downturn and it's the end of the bull market, because that's what everybody keeps on talking about since March 9, 2009. Okay, the bull market's over. The bull market's over. Well, the bull market ain't over. In between, we get very large, heavy volatility that we incurred over the past couple of weeks. The month of August was nothing but 800-point moves up and down, which I charted out, walked you all through, and overall net, we did very well. Can't run away from volatility. The key part of this morning's ACS session, which I always keep on explaining to all of you, ladies and gentlemen, is the trade management part. That is something that we have to constantly improve, myself included. The trade management part is part mental, part technical, part luck, and mostly how fast you react. Whether you're a swing trader or a day trader, it does not matter. Trade management is key. It comes from repeatedly practicing the disciplines and the rules, which are flexible, but still there are some basic rules of trade management. 1 + 1 never equals 2 when it comes to the world of stock trading or option trading. So please keep that in mind. Everyone waits for a perfect moment. Yeah, there are perfect moments when we're down 800 points, but very few tend to step in at those levels. We do. Last week was a prime example, was a microcosm of volatility that occurs all through the year. We started off Tuesday with a big thump down right there. I'm sorry, Tuesday was right here. Yes, this September 3rd. This was a big crash on Wednesday. I mean, so at the end of August. And look what happened through the week. There, and this is where we landed up. This is where we are right now, which features up about 5 to 6 points. And we can clearly see, as I said when I posted out the last end of the day chart on Friday, this is the only chart that you need to print, save, understand, replicate on your side. If you can't do it, I'll help you. I'm always helping my members, as you all know. And just track this. This is the range the market will travel in my opinion, this week. That's a very wide range, ladies and gentlemen. That's about 500 points. Can we get to 30-20? Who knows? But I'm just showing you the actual roadmap of this uptrend channel that started, and this is the microcosm of the full year, believe me. Okay, like from December 24th. Imagine August 25th to be December 24th, the Christmas Eve massacre, and what the markets did from there. Well, this is a microcosm of that, encapsulated within a matter of 2 weeks, 2 trading weeks. So this, honestly, this is the only chart that you need to manage and protect your profits, manage and lessen your losses. And of course, for SPY traders, this is basically the holy grail of tactical trading. These very precise technical charts that I produce throughout the day. All right. So this week we are going to look at the economic calendar right now, which will give us what the economic catalysts are, and let us start. Perfect. And this, so again, I repeat, two things you got to do. If you haven't had a chance to really see how accurate and everything that we talked about, and we're going to look at the same charts and look at what happened on the technical basis, everything last Sunday, please, got to review it. Really want to enhance yourself? People ask me, say, well, what can I do? Should I read a book? Well, I don't read books on trading. Sorry. Because most of the books that are written from way back, and I've read books on trading and stuff way back, are not applicable to this new normal of intense algorithmic high frequency trading volatility. You got to use your own resources, and you can use all the fantastic resources. Please listen to last Sunday's webinar. Listen to this Sunday's afternoon's options trading basics coming from a new member. And believe me, that's like reading 10 books. So saying all that, let's look at our economic calendar coming up. Monday is September 9th, tomorrow. What do we have here? Pretty much nothing. Consumer credit at 3 p.m. is important. We want consumer credit to stay above previous months, or at least continue in the path that it does. We don't want consumer credit to go berserk. We don't want it to crash, in which case the market's going to pull back real hard. That means people are starting to slow down their spending. And consumer credit is directly tied in with consumer confidence. You get more credit because your earnings are good, you're feeling comfortable, you want to go out there, use credit to buy cars, houses, all kinds of stuff, durable goods. So this is important. Tuesday, we have the small business optimism index. Important, not that important, but still worth noting. The JOLTS job data gives us a sneak peek into U.S. employment, so that's important. Nothing else there. Wednesday, we have the PPI, important, producer price index, shows us the inflationary part where the prices are rising or falling on the materials that companies buy, which is a producer price index, which go into making the finished goods. When Thursday, we have CPI, very important, consumer price inflation. What is the economy heating up too much, or the basket of consumable goods going higher? That's how they measure the CPI. By now, you all know. If the inflation is too hot, the market's not going to like it too much. That means the Fed, which is coming up on September 18th, the major Fed meeting where they're going to cut either 25 basis points, which is quarter of a percentage point, or 50 basis points, which is half a percentage point. And I said it very simply on last Friday's the tweet. Print that one too. 25 basis points, the market's going to fall because the market is expecting a half a percentage point cut. Markets are very spoiled beings. They want things now. Okay? 50 basis points, the markets are going to rally, then they're going to pull back. It's really as simple as that. They give you quarter of a percentage points, the markets are going to fall. And by that time, the markets will probably be technically severely overbought. It all goes hand in hand. Jobless claims important, Thursday. What else is there? We have money supply. No one ever looks at that. Then we go into Friday. Retail sales, very important, very important. Import-export price is important. Why? Because we're having a trade war with China, having skirmishes with trade with Europe. We have NAFTA, all kinds of stuff. Business inventories, important. Consumer sentiment, very important, 10 a.m. So all of these things intraday will move the markets, as you know. Now let's look back the following week. So the following week would bring us to the 16th. And that is the week that we're focusing on. I believe that on or about the Fed meeting, here, meeting announcement, Wednesday, September 18th, we are going to create possibly prior to that, a substantial tradable top. What is a tradable top? A tradable top is where you need to initiate short positions or get the heck out of any type of substantive long positions, especially on the indices, SPY, DIA, QQQ, things like that, or lessen or reduce your long exposure. In other words, position size. And that is 2 p.m. And we have the Fed press conference. And you know how the market reacts a lot to Fed Chairman Powell and his nerdy statements in most cases. He's a very dry guy. He's a great guy, but he's a dry guy. And then he might be attacked if he cuts 0.25 percentage points. He's going the tweet storm attack by President Trump and all kinds of stuff. But he's a gentleman. He doesn't react to that type of stuff because I personally think that's childish stuff. So bottom line is be ready for that. That's all. And that's September the 18th. I'm not going to project out to October and stuff because October is a very volatile month. Every month has been volatile this year, so nothing new about that. We're going to go into that and further webinars, tweet alerts, all that kind of stuff. And we have quad witching on Friday, September 20th. Now, quad witching generally, now this is important, this is monthly options expiration, generally run up into that, or at least that morning, is a positive event. Quad witching, not triple witching. There are 4 witches flying on broomstick all the way up, right? Quad witching. Read the definition of what quad witching were: index options, all kinds of options expiring the same day. There's a lot of volume, a lot of volatility, and it happens to be September. It happens to be right after the Fed meeting. There's going to be a lot of movement. Generally, up move, then fall. Let's see. Read up the definition of quadruple witching on Investopedia. All right, so that's your economic picture. We're out of earnings season, so more sporadic earnings coming out, but we're going to be starting to get earnings warnings or earnings guidance, pre-earnings guidance starting in October for the 3rd quarter, right? Because starting October 1st is the 4th quarter of 2019, October, November, December. All right, we're out of this. Next thing we're going to look at is, and we're just going to barrel through these charts here, is this. This is a key critical chart. Okay, trying to draw a star. So basically, this is the chart you need to be looking at. 2940 to where we are right now, that's almost 50 points. That's almost 400 Dow points just from where we are right now to there. If we move on to this level here, which is possible, we have an ECB meeting coming up this week too, European Central Bank. So that's also going to be a major catalyst on that. We have always Brexit looming in the background, even though it was initially defeated by the Parliament, UK Parliament, even his own party members. Basically, a lot of them quit. He fired some of them. I'm talking about Bojo or Boris Johnson. He's a very smart guy, by the way. But he's playing a hardcore poker game on the no-deal Brexit, and it looks like he's losing the support of his own party. So that has to be watched very carefully. So if we move up into this range here, then we're going to be hitting these levels, 3010, 3020 on the E-minis, and pretty much approximately the same, or a little bit, a couple of points adjustment on the S&P 500. And this is a very clear representation. That's just got to watch it. Here are the downside supports in red. Here's your support channel. That's 400 points. From here, 3,320 is another 160 points. So we basically have 560 to 600 points, which is basically the width of this channel. Always keep in mind, is the channel uptrending or is it downtrending? So even if it comes down here and bounces, it is still uptrending. But as options traders, we have to manage our trades accordingly based on every single tactical line that is here. That's the only chart that you got to watch. This is a 15-minute chart. Every bar is 15 minutes. This is what happened this week. This is what I said was going to happen because there was the volatility cluster, the pattern symmetry. Any of you who's been following the tweets or trying to make some money on this powerful bull market, heavily powerful, volatility-driven bull market, knows that I said that this was the volatility clusters and that high probability it resolves to the upside. That's exactly what it did, ladies and gentlemen. This was back on the end of August, and this is this week. Don't get irrationally fearful. Don't get irrationally euphoric or too happy. Just stay calm. None of us are reaching our potential. None of us, myself included, despite these phenomenal forecasts and alerts, are reaching our potential of what we can do. And some of you are not even trying. Those are the people who really need to check their mental state on the trading side. You always have to strive to reach our potential. None of us are reaching our potential. I'm a straight up guy. I'm telling you that right now. And the volatility keeps us on our toes. But we can always get there. 80% optimal performance is peak performance in my book. I'm running at maybe 60%, not ROI or return on investment. I'm talking about 60% performance-wise. I would like to be at 80% plus. But volatility stops us from doing that. So let's kill, literally destroy, decimate these algos and try to maximize, like we say, profit maximization in volatile markets. Let's try to get there, all of us together. Let's move on. That's your 15-minute chart. The next chart is your 1-hour chart on the S&P 500. This is a very useful chart. Why? Because in one glance, you can see what the hell is happening with the markets. You can see the patterns all put in shades. This is to get your attention. There are many people out there whose brains are not tuned. There's nothing wrong with that, to look at technical charts. They just like to rely on chasing prices up and down. Doesn't work. So these are there for all of us, but primarily for them so that they can see the broader trends. And even put those captions here: Hong Kong airport closed, we get that pullback, it opens, boom, it goes higher. Then we fall really hard, 800 points was here, I guess. US-China tariffs go into effect, the market goes into a volatility cluster down about 200 some points, and then see you later as the news comes out, which I predicted exactly to the teeth, that there would be some announcement regarding that the markets would rally hard on any type of date announcement for the Chinese delegation to arrive. And that is exactly, we don't have an exact date yet, but they came and said it's going to be beginning of October from the White House and President Trump. And look what the markets are doing. There has been, like Kramer said, it was a very interesting article, mind you, about a sea change, because he's very connected, obviously, with a lot of portfolio managers and stuff who are severely underperforming the market. And he said that there's a sea change in the way they're looking at, they feel there's going to be some sort of balance, some sort of ceasefire, some sort of moderate framework for a US-China deal coming up. So money, which is 6, 7, God knows how many trillions dollars sitting on the side, which I've repeatedly talked about, is starting to flow back. That's the reason why you have these big couple of 100-point moves. Because big money, when they step in, ladies and gentlemen, they're like elephants stomping, not like little mice, and that we all are in the scheme of money in the stock markets, right? We don't leave footsteps. They leave footsteps. These are the footsteps. These charts are the footsteps of the big money starting to step in. That's the reason why you get such a huge return based on my alerts on Apple, on Nvidia, on Facebook, on Twitter, on many other stocks. Those are the footsteps that the big boys are starting to step in. When those footsteps begin, they don't finish in days. They take a couple of weeks. And in between, you get these type of dramatic, quick, sharp pullbacks. But the trend overall goes up. Pullback goes up. The market can go a lot higher than any of you and any of me, and myself included, can imagine. Nobody expected S&P 3000 when it hit back at the end of July. Nobody. We did. Somebody, a couple of guys in Stockton said, "Yeah, right. So they made fun of my charts." Great. At least you looked at my charts, and if you acted on it, you'd be sitting there with a decent sum of money. So we're not even back to, just keep in mind, we're not even back to the old highs, which is up here, which is another 100, 200 points or more, 100 to 300 points. We're not even back there yet. So all the market did was move in this very wide range, and now we're just about to go there. So what if we break out of there? Have you ever thought of that? Can it not happen? It can sure happen. it seems like the 10-year government bond yield has found the bottom at that 1.427 level or whatever it reached a week, 10 days ago, and now it's starting to creep up. So what if there's inflation numbers which are a little bit stronger and bond yields suddenly start to spike a little bit harder? That means money coming out of the US Treasury bond market. Where's that money going to go? Straight into stocks. Think. Money can't sit on a 1.42% yield forever. S&P 500 dividend yield is now roughly about 100 basis points. I think, I don't have the exact number, or maybe a little bit more, 1% more or so from the 10-year government bond deal. That has only happened a few times in history. So it makes more sense to sit in a stock, which is a growth vehicle, where your underlying capital appreciation can happen because your stock prices are going higher. And on top of that, you're earning 2% plus on your dividend on average. And in some cases, 6%, 7% on individual stocks. Just pure dividend yield. They're just landing that money to your hand every year instead of your money sitting in a bank at 0.5% or 1% or whatever it is on the money market accounts. Think, ladies and gentlemen. Okay, so there's your chart on the 1 hour. Next, and one step at a time. We look at levels, we trade these levels, and we're prepared for these type of things to happen, even though sometimes there are black swan events that just suddenly appear before the market opens or after hours. We react to it, and we have done well with it. Stop the demons in your head. Decimate them, honestly, or else you're not going to go anywhere. Constantly try to improve your trade management skills. I do. And you will see the results of that. Maybe not in 1 day, maybe not in 2 days, maybe in 2 months. You start to see the consistency. It becomes second nature to manage your trades. S&P futures right now are 7. You can see that what's going on right there. That's a bull flag. That was a bull flag. Next, this is a beautiful chart. This is the same chart. This is the same chart without the big, broad directional representations and the captions. That's the same chart. Again, print this chart, screenshot it. There are multiple free screenshots programs that you can download, or just use your print screen button, whatever, on your computer. Technology has been given to us. We're the finest, we are the ultimate in technological development, high tech. Use it, print it. What's so difficult to understand about this chart? I don't know. The difficulty comes in these type of sudden moves, but you can clearly see what's going on. These lines, every one of them are hitting contact points. You really can't get any better than this. These lines are not drawn randomly at the end of the day because I just wanted to just draw lines. No. There is a technical purpose and a technical reasoning behind these lines. That's a rising wedge. That's why it's in magenta. Upper end of that wedge is somewhere around 3,000. Somewhere around 3,004. This channel is 3,005. The extreme channel from here, not really extreme, but short-term extreme channel is 3,020. I can do this. Where does that land up? 3,000, almost 3,050. And it can happen. So don't let the market just pass you by because you're sitting there in a state of massive, unnecessary fear. If you're comatose as a trader, you're never going to make profits. You're going to lose some, sure, but you're going to gain more. You got to fight back. Anyway, so there's your 1 hour chart. Print this. I'm going to be showing this throughout the week like I always do. And every single one of these levels might get hit. The lower end and the upper end. And this is the ultimate critical level, which is 2890, because if we break 2890, that's hundreds of points below, chances are we're going to go into 2800 again. And that puts the short-term trajectory of the bull market in jeopardy. I believe that most probably this will happen in the month of October. I do believe that, and give us another major opportunity. October, mid-October, and going into the third week of October, extremely volatile period. That's the end of the fiscal year for the multi-trillion-dollar mutual fund industry. End of the fiscal year, they do a lot of juggling. There's a lot of statistical, technical moves. That's why October is always, remember, the crash of 1987 happened in October. October's always very, very volatile. And I believe that we probably get to 2,800 by October. That'll be a good drop of 200 from 3,000. If we drop from 3,000 or thereabouts to 2,800, that's 200 handles on the S&P 500 futures, multiplied by roughly 8. That's 1,600 points in the Dow, which can happen very quickly. Happened here. And on the upside, we know where we can go. At one point, people are just, there's going to be just this fear of missing out. They just can't take it. They got to call up their mutual fund guys. Hey, listen, all that money sitting in the sidelines, a money market account. Can you put 20% of that in this growth fund, blah, blah, blah? That will be the stage 5 or Elliott wave 5 of mini euphoria. Because the retail investor, just in general, is always late to the game, always early to get out of positions. Yes, they might be right once in a while as the markets pull back because of all the different types of black swan tweet risk, comments out of China, blah, 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 but they never get in. So at one point, now we're really breaking out. You see the breakout here, S&P futures are up about 8. So that's your 1 hour chart. Next one, zooming out. We're zooming out to the daily. Bollingers now are stretching higher. So one of the things I want to point out to you, Bollinger Bands are great visual representation of which way the directional bias on the markets. I told you we would get to the 50-day moving average. That is your 50-day moving average. Still sideways through all this intense volatility. We talked about that extensively on the previous webinars, including last Sunday's. Review it. We are now over it. We broke over it with a massive breadth thrust. Big move. Has to be one of these big fat 400 plus type of candles. We took out, there was a red arrow here, meaning that we'd find resistance. We took that out, no problem, on the 50-day moving average. All that happened on the 5th, of, which was Thursday, right, of September. Breadth thrust. Now we are hugging and pushing the Bollingers higher, and we are creating a very beautiful bull flag. There you go. Here, we couldn't really detect bull flags. We were trading a channel, and I was walking you through it based on this thing here, which I showed you guys repeatedly in the past couple of webinars, including last week before Labor Day. I mean, last when was it? Last Monday. It's not last Sundays. I keep on repeating. Monday, I had the webinar. So that these internals were suggesting that we're going higher. Now we are getting into that overbought level. Just because we get into the overbought level doesn't mean we have to crash and burn. We can stay above the 80, 90 range on the full stochastics and keep on pushing the market higher. So now we had this box here, and now we have this. So you had that box, then we broke out with a vengeance, and we have a bull flag here. Whoa, it's pretty serious stuff going on. That's when the big boys are stepping in. Like Kramer wrote in one of the CNBC articles he did on one of his shows, they are starting to see change. I don't believe see change. They're just getting in because they're always late. Where were they buying at this level at which we were? Exactly. And when I say they, I'm talking about the so-called smart money. Forget about the retail mom and pop operator. They're just like lost. And hopefully none of my members are. So here's your 34-day moving average. You're starting to see it now start to curl up. What if it happens with the 34 crosses over the 50? Like it did here. You get multi-day rallies. We're not even close to that. We'll see how that happens. In my opinion, probably will happen. Your MACD, which I said, crossed over here during the second major volatility move down, kept on continuing to move higher, where the histograms depicted here in an area, the green area, kept on moving higher. Said, stay long, still saying, stay long. Despite the volatility, the internals were telling us the market wants to go higher. Now, along the way, each of these levels will find minor resistance. Bull flags go up, then they pull back, then they go up. Exactly what's going to happen. So buy time. Don't look at your P&L every 5 minutes. It's going to drive you nuts. Want to be a swing trader? Oh, I'm so busy, my work and stuff. Well, please don't tell me how busy, because I'm busier than most people. I work 14 to 16 hours a day overall. I do. I'm always putting out stuff, always doing the coaching sessions, full day on trading, always connected with you guys. So please don't tell me how busy you are. Then if you're that busy, then don't look at 15-minute charts, 1-hour charts. Look at the swing charts. There's no excuses in this business or in life. Let's take a look at zoom out. So this is good. This is good. Just like I said, this is good. 34-day moving average starting to move higher. However, keep in mind, this is another thing. The more that we move away from the 50-day moving average and the 34-day moving average, just the way we stayed below that for the whole month of August, right? That's called standard deviation. In this case, it was like a -5 or 6 that we have fallen off the highways. These are the highways the markets like to travel in. Talked about this extent, just keep it simple. Anyone can understand it. A child can understand this. So the more you move away from the highways, in this case, the red line and the brown line, which is the orange line, whatever, on the 34-day moving average, the market starts to get stretched. That means we get extremely overbought. Now, if you look at this move here, this is something a lot of you know, and I'm going to have you answer that. Jody, you're connected. So what is this range here? This is 29.40, and the bottom end of the range is roughly 28.10. So what is the difference? What is the depth of this channel? This one.
30 points.
30, right? Yeah, I just wanted to make sure.
Yes.
Because the top end of the range, is it, what is the top end of the range? I mean, obviously I mentioned it many times, 29.43. So 60 points, sir. 2,800 roughly to 28,
Oh,
yeah, 28.40. Yeah, 60 points, double that. So 60 points. So back of the napkin calculation, which works a lot. This is from the old Wall Street days when humans really controlled the market. You got 60 points of depth here. Breaking out of here, you should, technically speaking, but it happens all the time. You get a 60-point breakout. Now, this doesn't happen. This is a weekly chart. This daily chart. It will happen in one day. It's going to take multiple days. But if you add, we broke out of around 29.40. Let's call it 29.40. So if you add 29.40 to 60, where do you arrive? 3,000. Lo behold, that's pretty much where we're going in this range. So, one second here. It is not. I'm doing something wrong because visually it's not connecting with it. 2,800 and 29.40. We're both wrong. 29.40 is actually 140 points. Yeah, I don't know why we know. It's just supposed to be. Okay, 140 points. So because visually it didn't make sense. Look at the depth, and I'm like saying it's just, we're going to just stop here, 140 points. So if you do the box, the depth of the box is 140 points. So if you add 140 to 29.40, where do we arrive? We arrive at
3,080.
We arrive at 3,080. Now we're talking business. Okay, we arrive at 3,080, which is all the way up there. Now, if you look at this, if I draw one more line, which will be technically a valid line right there, 2 points of major contact, right? Where do we arrive? 3,080, almost. Whew. Technical magic, ladies and gentlemen. 3,080, just on that big range breakout. 3,080, right there. Remember, when I do these strategic webinars, when they're so accurate, most of the time, I would say good 80% of the time. I can't go back and delete a webinar and say, oh boy, no, I'm just going to change it. No, I said it by mistake. No. It's there. My track record is there. Somebody says, hey, what's your track record? Well, my track record is pretty damn good. So why don't you go review the Google YouTube channel? Why don't you go through my Twitter feed and look at my track record? But the Google YouTube channel, that track record is set in place. So at one point or another, we go to 3,080. That's 140 S&P points times 8. Now, this is not something that's going to happen overnight, but it's going to happen pretty fast. 140 times 8 is 1,120 Dow points, which would bring us to, we are at 27,697. If we add 1120, which would bring us to about 28,800, just rounding off on the Dow Jones Industrial Average. Maybe by the end of the year, maybe earlier, but it's possible. And in between, we know what the levels are. Okay, let's move on. And that's going to pull a lot of big name stocks higher in the Dow Jones, our Boeing included. That itself can drag the market to the Dow to 28,000 on a resumption of 737 Maxes up in the air. We covered this. Now, this is your daily chart. This is your weekly chart. So the weekly chart, as you can see, we are entering the overbought. We are starting to enter this very overbought zone, and that's a danger sign. That means the market can be really frothy. Now, once we entered that, we don't necessarily have to crash and burn the same week. You can move sideways, like we did here back in July and August. August was down. So we could move up here, hit that max. I would say max upside at this point is 30.20 to 30.50. But you can see a clear representation of that. Again, I was dead correct, dead right, because I repeatedly showed it to you guys. Pattern symmetry. Look at that. The following week, after a big move, the week was slightly, it went higher, but it ended with a red doji. So we might end this week with a red doji. That means, you know, it goes higher, then it pulls back a little bit, and we hit those levels, the 3010 level, whatever, and it's a red doji. What happened the following week? Another big move up. One with the other, we want to go to 3050 on a technical basis, and it gets severely overbought in 2 weeks. And that should bring us into, like I said, the Fed meeting. Magic, huh? There you go. And I'm just looking at pattern symmetry from the week of big breakout on the week of June 17 this year. Then the June 24th was up, down, closed in the middle, red doji, and the following week went higher. I'm sorry, it was June 10th, and then the following week, big bullish candle. Same thing can happen here. It's the exact same pattern. Machines trade on these patterns. They're systematic. Quant funds, they call them. Okay, that's your big picture. And around these levels, the market gets severely overbought. What else are we looking at? Just want to update on things. We are looking at, let's take a look at the McClellan oscillator, right? Very important. Told you guys to buy the McClellan oscillator many, many times. Hands down, when it's minus 26, minus 52. You want to put house down and buy, you know, just the saying goes, get a second mortgage on the house and put it down when it's minus 78. That was August. And look what the McClellan oscillator shot into positive territory. Now we have a minor crossover here of the mid-Bollinger over the 50 moving average. This line is the 50-day moving average. It is still minus 1.82. By the time it hits that 50 range and 64 range, guess what happens? We get severely overbought. Boom, the market falls. No magic. It's rushing forward. Probably move up a little bit. Then it starts to diverge and go down, and the market still kind of goes higher. That's known as a negative divergence, where the McLaren oscillator, and it's not just McLaren oscillator, anything, any MACD will show you that. It starts to ease back, and the market still moves higher. That's where the latecomers come in. And then they get, boom, slapped down. And then they never want to look at a stock again, till they again want to look at a stock. Right? Same old story. So we're getting overbought on the McLaren oscillator. No question about it. Extreme overbought would be R1 resistance once generated by the system, the NIMO hitting 64, 65, or 70. So this is good. Now, this is your daily. So let's take a look at the weekly. What is the weekly telling us? More longer term swing picture. The weekly is telling us that we can go up again to 56. The R1 is at 136. We'll never reach 136 on the weekly reading on the stochastics. Never. 107 was the highest. Massive euphoria before the market collapsed. The December 24th. The run up in, after December 24th, this is what happened. Bang! The market just picked up and started running, right? After the Christmas Eve massacre on the markets. So again, once we get up to these levels, you can notice that very clearly. That means, and of course, I'll be showing this in my midweek webinar too. Get overbought. We're not there yet. This is good. We could get 1 or 2 more bars. That means we have 2 more weeks or so. And I still think the Fed's going to cut maybe 25 basis points. If they give us 50, this market's going to zoom like crazy, then fall. But if they give us 25 basis points, a quarter percentage points, FOMC, Chairman Powell and the committee, then the markets are going to fall. A couple of 100 points, just like that. And by that time, it's probably going to be severely overbought before it falls. They all go hand in hand. Let's take a look at the predictive chart to give you an idea on overall market 533. There we go. Still moving forward. I told you we're going to go into positive territory, right? Told you that, guys, that many, many times. Doesn't matter. Look at that. This is an exact representation. You can literally count the depth of this bar, which was to minus 20, which was a screaming buy. We probably get to up plus 20 up there. You count the number of bars. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And on the 11th day, we went positive. So 1, 2, 3, 4, 5, 6. We got a bunch of days here, which brings us again into the Fed meeting next week, where the market gets severely overbought. And once you start to cross, which I show you guys, once you start to cross like that, you buy. And that's when it goes in, that's when the histograms also start to go from negative to positive. Acceleration. And this is exactly what happened. Now, this period was extremely volatile, right? So we, like day to day, it was just like, but now that we're broken out, we have more of a technical probability driven type of market. Maybe that's why Kramer said there was a sea change in the investment institutional community with how they are moving money into the market. Who knows? Stocks. We have Apple coming up. Big event, I believe Tuesday. Get ready for some volatility. I think it's going to be, even if the stock falls, like buy it. Unless it's, they're going to introduce new phones. I can't wait for the new iPhones. Hopefully they bring a larger screen phone, more than the XX Max that I have. Makes my life a lot easier. But let's bring out the chart. Amba was a big winner. Ambarella. Told you it hit 60. Well, guess what it hit? It hit 63 for 51. Let's take a look at Apple, which is a big market mover. Apple's chart on the daily. Am I right on Apple? Okay. The Apple's chart on the daily. Technical. Let's look at the technicals first. Good. Getting into that zone here around 89.90 where it gets the full stochastic that's severely overbought. NIMO, McLaren oscillator. Good. Breaking over 100. MACD. Good. Not great, but good. We'd like to see these MACD histogram bars big like this. That's when you get but still positive. We'd like to see it explode into, go up to that 5 level. The length of these green bars, just simple, forget numbers, need to be really high. Can it happen? Sure. Now let's take a look at the external. Those are your internals. Let's take a look at the external, which is the price chart. So if you look at Apple like this, Apple bulls will say, hey, this, ladies and gentlemen, is a very powerful cup and handle. One handle broke out within this range. So what's the upper end of the handle? 220, 230. Can it happen? Yeah. It looks pretty good. Now, in between, you get these red days, sudden falls, Apple down 3-4, some analyst comes out and say, oh, they're going to be out of business and all that garbage you hear. Apple keeps on making more and more and more money from their services. And God help us that their refresh cycle on their new iPhones go beyond the so-called pessimistic estimates out on the street. And Tim Cook, as a great CEO, he's well connected with Donald Trump, President Trump, and he's very well connected with Premier Xi in China. What more do you need? He's connected to 2 most important people in the world. So technically speaking, you have, I'm just doing some broad brush strokes. This is your Apple trading chart. Okay. If you want to play the broader proxy on the tech market and the overall market, play Apple. Apple SPY. Just focus on 2. Honestly, Apple SPY. Want to get a little bit more specialized? NVIDIA QQQs. Just do some pair trades like that. I teach a lot of this stuff on the ACS advanced coaching sessions. You want to learn how to do pair trades and stuff? Join the ACS sessions. Sign up for it. Pay those couple of bucks to manage all these systems. And a little bit for my time. Not that I get rich off the ACS fees, that's for sure, or else I'd be broke. But do that. Do some pair trades. So Apple's looking good. And that is a major move event this Tuesday. I play Apple for sets of 2 to 4 points because that's how it moves. Here's your actual range. This was the blow off top. This range is 222. First range low is 200. That's 220, and this is the second range low, 214. Those are 14 points. Those are good for 300+% on weekly options. You all know that. Any other stock anyone wants to look at? Because I want to wrap this up.
How about NVIDIA?
Yeah, I was just going to put that up before you even said it. You read my mind. So NVIDIA has been on a tear. When you look at the daily chart of NVIDIA, keep in mind NVIDIA is in artificial intelligence. NVIDIA is, there was news last week that the Chinese government is looking to approve NVIDIA's acquisition of Mellanox, MLNX, which they bought, but it has to be approved by US and Chinese authorities. So that was a very positive piece of news. NVIDIA does more than 50% of its business in the China-Asia region. It's a very powerful company. When you look at, and we've been trading NVIDIA all the way from 146, 150, 160, this is where we are. So short-term basis, NVIDIA is now going to hitting a major support range, which it has failed from 3 times since May of this year, right? We see that. The broader range is 195, 194.33, right? Which was the breakdown, the gap breakdown back in November of 2018. The lower range is 120 to 130. And once it got there, we were never exactly at the bottom, but we started to get in at these levels. At this point, 146.50, 147, 145 is your worst case scenario. That's a long drop from 180. But as you can clearly see here, and again, you don't have to be a technical genius. Yes, I'll look at those 2. Mike put out 2 other great names that are involved in, which is American Airlines and Boeing. So NVIDIA, there's a lot of positive sentiment on NVIDIA right now. So if NVIDIA breaks out, you're looking at 194 to 200. NVIDIA pulls back, you're looking at 171. We need NVIDIA to really break out. Why? Because then the technicals really turn and it means the uptrend is confirmed. Now it's just in a trading range. But a longer term uptrend at NVIDIA and on any type of China deal, NVIDIA will burst up 10, 15, 20 bucks. No question about it. So NVIDIA right now, this is happening. The 50-day moving average finally has started to curve up and attempting to cross over the orange line here, which is the 34-day moving average. So saying all that, once it does that, NVIDIA will bust a move and get towards, you got another 20 points in the books. And that would be a major pattern completion. Because in order for NVIDIA to move above this level, it has to be solid earnings, some sort of cessation of the technology hostilities between US and China, all kinds of stuff. And at that point, the stock breaks out, it's going to go to 230. This is a serious company. It's in gaming. It's in artificial intelligence. It's in autonomous driving. It's in NVIDIA graphics processors. I mean, you name it. We know. So bottom line is, from a technical standpoint, this is a high probability move within the next week. We know what the support levels are. If NVIDIA, for any reason, comes towards the 50-day moving average at 165, chances are it's going to break lower towards 147. So watch the candles. Watch the candles, okay? Look at where NVIDIA was. It was a $300 stock, ladies and gentlemen, on October 2nd of 2018. NVIDIA bulls will say, dude, you have no friggin' idea what Jensen Wang, I think that's his name, right, can do. Yeah, he's probably right. But here's a gap here. That gap is around 225, right there. There's a gap here, and that gap is right this gap. I'd rather be playing one step at a time. I have no idea if it's going to get there. But God help us if NVIDIA breaks above the 200 level. There's a lot of committed shorts in NVIDIA. They are just going to burn and technically die. That means short squeeze. But I'm looking for the next 10 to 20 points. Major resistance. Next stock, Boeing. Boeing is the ultimate swing play. Boeing is volatile. Boeing's chart is fantastic. I'm going to stick to it because I believe in my charts, which have worked 80 to 90% of the time, as long as somebody has the technical discipline of holding it. This is your trading range on Boeing. 320, 380 to 400. This is a cup and a handle and a breakout. This is a inverse head and shoulders. This is a major gap. This could be a large head and shoulder. This is your major gap that needs to get filled. Will get filled. No question about that. Let's look at the price. Upper end of the gap, where it broke down from on April 5th, 2019, 390.28. Lower end of the gap, 380. So where is the stock? 360. You can make money on this stock. You gotta buy, look at the technical patterns, and you gotta buy the dip. Not just randomly. If it breaks below the 50-day moving average, 350, the stock's going at that point, going straight to 330. But given where we are, and this is the daily chart, the stock looks good to attack. First, the 375 level, 370, which is the 150-day moving average, which is a critical average used primarily by hedge funds and institutions. So again, play it in 5, 10-point instruments. And if you believe, you buy some calls in October, November for the 390, 400s. Will it ever get to that 400 to 420 gap? Yeah. Once the 737 MAX starts to fly, I'm going to draw a plane here. Oh, I drew a plan. It's going to go straight to that gap. It's the magnet. So if you're really bullish, buy the cheapo calls, 800, 400 calls all the way to December. And watch the 737 MAX go into play and Boeing go nuts. Look, if Chipotle can go from 250 to 800 on rats falling from their roofs, salmonella poisoning, God knows what poisoning. Remember Chipotle 2 years ago? It was like one after another. I mean, it was just crazy. If Chipotle, with all those issues, avocado prices going nuts, rats literally falling from the roof, all kinds of poisoning and all that stuff, And that stock went from 250 to 800, plus going to 900. Why can't Boeing go to 400? Think about that for a minute. Boeing had one fatal crash, and they have done everything and doing everything to make sure that never happens. It is one of the finest companies in the United States, in the world, and everybody loves Boeing. Our mortal enemies out there in other a couple of other countries love Boeing. So think about that for a minute, all right? So that's your Boeing. American Airlines. I'm bullish on American Airlines. I think American Airlines is a phenomenal, cheap, extreme lotto options. 15 cents, 20 cents, 30 cents, 40 cents, 50 cents. American Airlines is starting to get overbought. So what does it mean? That means I believe that 50-day moving average will get engaged. And that's roughly about $1.72. That means your calls will be up about 200%. They're cheap calls. They're lotto tickets. You don't want to put your large portion of your trading capital in these lottos, but you need to have a decent sum, because when they go from that 28 to 29.72, this is the daily chart, and this is all confirming that those 15 cents, 14 cents, 18 cents, 19 cent call will be 60 cents to $1. That's like let's say 15 cents, okay, 0.15 goes to 60 cents, and that happens like fast, right? Within a day or two. That's 300% net profits, or a 4 times return on your money, 300% ROI. So if you don't have a reasonable position, you're just going to be like, oh boy, it moved and I just made like 10 bucks. So that's up to you. I can't dictate what you put in. If it breaks above the 50-day moving average, remember, every single time it's come down to these levels, it moved up on average of 5 points. Average of 5 points. Average of 8-10 points. From 29.30 to 36, 7 points. So average of 5 to 6 points. Don't need to be a technical genius to figure this out. So if you just take the average, the bottom was 24.32, add 6 to it, you're at 30. What else can we read on the technical side? Let's look at the MACD. Let's look at the underlying strength. This is fine. It's getting overbought, probably move sideways a little bit as the stock tries to attempt to break out over the 50-day moving average. McLaren oscillator, beautiful. Histograms, really beautiful. Seriously, I told you guys to buy a couple of days ago. It started to shoot up. Then the market volatility kind of put a little cap on it. This is the breakout. You want to be a technical trader? Follow the technical signals. You can't be. You see, this is the thing about tactical trading. Technically, you can't be a technical trader and a highly emotionally charged RET, retail emotional trader. You can't do both. You gotta pick a way. Always emotions are involved. That's fine. This is real money we're dealing with, and we're dealing with heavy volatility in the market. But you can be both. Gotta make a decision, a conscious decision today, tonight, in your head. Do you want to be a technical trader, or do you want to be a highly supercharged emotional trader who freaks out every time the markets go up 300-400 points up and down? So I think that's fine. I think this expands a little bit more. Remember, the stock doesn't get overbought till both these lines, the MACD 1226.9 exponential lines, this is exponential MACD, go into the positive zone over zero. That's when the stock starts to basically get overbought. We're not there yet. I think it's a pretty phenomenal swing trade. It's not a day trade. And if it jumps up a lot, take some out. Every single time it has gone over zero and the stock has topped. Every single time, going back to October of last year. So that's your answer to American Airlines. So ladies and gentlemen, thank you for listening. Hopefully this helps all of you. You know what I have to say. I've said it. Stay focused, stay disciplined, stop being scared every single day, every single minute, because that's the nature of the beast. That's what's happening all across the investing universe. The media will scare you. The media will be super negative. There are very few of these people who are positive on the market. Some of them are. The question is, the ultimate decision is with you. You decide whether you want to live in a state of fear, which means you're going to lose on almost every trade, even when you're up on it. Even when you're up on it. or you want to live in a state of tactical calmness. That's really what it is. I'm not kidding around. Where you don't get super excited, you don't get super scared. Try to stick to the charts. Try to take scalping profits or leaving profits to run, moving strikes higher. It's all the trade management aspect, and do better. So I wish you all well. See you guys tomorrow. Let's have a great week. Thank you.